very much. Everyone, hi there. Sorry for our technical difficulties. We appear to have fixed things now, so we're going to go right into our presentation and our three speakers. With that, I'm going to pass things over to our moderator. My name is Suzanne Evans with Genscape, and again, we apologize, and we hope you can stay on to listen to some of the really great content and opinions we're going to be sharing today. Our moderator for today's webinar is Alison with the Wall Street Journal. Alison?
Thanks, Suzanne. I'm just going to turn it right over to the speakers. We're going to be hearing first from Andy Lipow, President of Lipow Oil Associates, LLC. Then we'll be hearing from John Auers, Executive Vice President of Turner Mason and Company. And finally, we'll hear from Mark Smith, Executive Vice President at Delek. And then we'll have an opportunity, hopefully, for Q&A. So, Andy, if you want to start us off.
Sure. Well, thank you very much, Alison. Just move on to where we're starting here on the slides. So today I'm going to talk about a couple of items. I'm going to talk about the Brent-TI spread and exports, and then I'll look at gasoline and distillate here. Then I want to talk about what's going on in the Ohio Valley, since that's impacting the Mid-Continent and the East Coast. And then a brief comment on RINs, and then finish it up, and I'll turn it over to the next speaker. So as everyone's aware, we've seen a lot of volatility in the Brent-TI spread, and there's four major reasons why this is occurring. I look at what's happening on the U.S. refinery capacity, and as capacity is increased, that's a demand side of the equation. At the same time, the U.S. production has been declining, and that's impacted the supply side. But we also have a couple of other effects, namely in the pipeline system, and the lifting of the export ban, and all of these have combined to impact what's going on the Brent-TI spread. So if we were to look at new crude distillation capacity over the last 12 months, over 500,000 barrels a day of capacity has been added, and there's at least another 200,000 barrels a day on its way over the next 12 to 18 months. Many times people ask me, well, how could that be? We remember all the big things like the splitters, whether it's Marathon, Kinder Morgan, Buckeye, or Bayview Refining, adding about 235,000 barrels a day capacity. But none of these splitters make any finished gasoline, and they add a lot of low sulfur diesel and jet fuel into the market. Meanwhile, the big refiner who's been adding a lot of capacity is Valero, between McKee, Corpus, and soon-to-be Houston. And if you were to look at this 185,000 barrels a day capacity that they're adding, they're only incrementally going to make about 24,000 a day of gasoline and 25,000 barrels a day of distillate. We've got a number of other small expansions that are going on that sort of creep up on you, whether it's Placid, Delek, Dakota Prairie, Holly, and even the major oil companies like Tesoro, Marathon Petroleum, and Phillips have been adding capacity in small amounts across their refining system. So although we're adding a lot of crude oil running capacity, and we're seeing that in the weekly EIA stats, we're not appreciably getting much out of the gasoline supply. But each of these projects have added to the demand of light sweet crude into the market, and if they build it, the crude is going to be bought and processed, and that's going to put strength on the WTI leg of the Brent-TI spread. One of the more interesting things to look at is how the refinery capacity has increased versus the decline in crude oil production. And I've chosen here the base case of March as my 0 point, and you can see how refinery capacity is increasing as we get through April of 2016, probably almost 800,000 barrels a day. At the same time, crude oil supplies have been declining in the U.S. If you recall, in April and March of last year, domestic production had topped out at nearly 9.7 million barrels a day. It's already down about 600,000 barrels a day, and this trend is likely to continue through the balance of 2016, further increasing the spread between refining capacity and light sweet crude production in North America. And to me, that's further going to support the WTI. Another thing that I like to look at, this is a very simplified map of the pipeline connectivity in North America. And I've divided the pipelines into those that are highlighted in black and those in red. And the difference is that the black pipelines are the legacy pipelines where they've People are shipping. There's no committed shippers, and people will want to ship and continue to ship based on their historical space. Meanwhile, all the pipelines in red, what they have to their name is they were all built and constructed with the backing of committed shippers who now have take-or-pay agreements. So they're going to pay the tariff whether they use the space or whether they don't use the space. And this is a big impact on when we see the crude oil differentials. And you're certainly seeing that up in the Bakken, where you'll see that the Enbridge Line 9 reversal came on stream last December, and now we've got the SAX, or the Southern Access Extension Project, that's delivering oil down from Flanagan into Patoka. Each of these are increasing pulls on Bakken and Canadian Sweet, and as a result, we've seen Bakken prices come into about today roughly 85 cents under WTI. Meanwhile, in the Permian Basin, we've seen a significant amount of pipeline capacity, whether it's Longhorn or the Permian Express, and in about a year or two, we'll have Enterprise with their Permian to Houston pipeline adding another 300,000 barrels a day of capacity. And unfortunately, we have additional amounts of capacity coming online at the same time in this low crude oil price environment. Production has been declining in Texas, which means there's a real scramble for oil to fill up these pipelines. And one can see how this arbitrage, say, from the Permian Basin to the Texas Gulf Coast doesn't work if one were to look at the BridgeTex pipeline tariff, which varies between $2.50 a barrel up to $3.85 for an uncommitted shipper. And if you have Midland Sweet trading at about 70 cents under WTI, and you have Magellan East Houston trading at roughly $1.50 over WTI, it's very hard to make that arbitrage work unless you're the committed shipper with the lowest pipeline tariffs. But each of these committed pipelines is putting additional demand on light sweet, causing prices to be bid up, whether it's in the Mid-Continent or in the Permian Basin or Bakken, to move this oil into the pipelines towards the Gulf Coast. And all of these have impacted, of course, on the Brent-TI spreads. So if one were to start looking at what's been going on the spreads, you can see that they've certainly been volatile, and even though this graph was made a couple of weeks ago, what you see is on the LLS-WTI spread, the spread even going out forward is only about $1.60 a barrel. That is not nearly enough to cover even the Zydeco pipeline tariff from Houston or Port Arthur over to St. James, which is running between $1.90 up to $2.30 a barrel. So the only reason to ship is because one has to ship it. The market right now is staying rather tight between Brent-TI, and when the curve goes below zero, then we're having premiums to LLS and WTI versus the Brent. And as we can see, this has been volatile right now. We've seen some premiums to WTI. We've seen LLS being a premium to Brent, which has impacted the ability to export out of the Gulf Coast, even though we continue to see exports occurring. And as these exports are occurring, you know, the lifting of the export ban has impacted the range between the Brent and TI. So now as I look at what should this range be, I've given quite a range here, with minus $2, meaning the premium is to the WTI leg, to a $3 premium to the Brent leg, which means if WTI was a $2 premium to Brent, what we would have is oil making its way into the Mid-Continent. We certainly wouldn't want to ship crude by rail over to the East Coast. The East Coast refiners would start importing light sweet crude from West Africa or the North Sea. At the same time, we would expect LLS prices to be at a bigger premium to Brent, attracting imports into St. James. On the other hand, if Brent got to a $3 premium versus WTI, you can be assured that lots of barrels will want to make their way to the Gulf Coast. We'll be exporting significant quantities out of the Corpus Christi area, and the world will get back in balance. And we've seen the effect of this lifting of the ban through the Enterprise product pipeline statements that they're now going to be exporting 200,000 barrels a day in March as the nominations for crude oil exports have increased. And we're seeing exports really to all parts of the world, whether it's Europe, Israel to Asia or even to Latin America. And of course, with the resulting lifting of the ban, we're having a significant infrastructure build-out with tankage being constructed in Corpus Christi, in Houston, as well as in Port Arthur. And commensurate with those tanks, we're getting additional places for dock construction, and that's enabling us to, in the future, export more and more crude oil as the arbitrage may see fit. If I move on to looking at products, product demand has been surprisingly robust and increasing since 2012. And in this graph, 2012 is sort of my baseline point. Since 2012, we've significantly increased year-on-year gasoline and distillate demand to today, where the cumulative increase is about 800,000 barrels a day, which implies a significant requirement for additional refining capacity. If one were to look in 2012, refinery capacity was about 17.3 million barrels a day. Today, according to the EIA January figures, capacity is 18.3 million barrels a day, and we've seen utilization rise from 88.7% in 2012 up to nearly 92% last year in 2015. And at the same time, our demand has been growing. A lot of that is being satisfied by increasing imports from Europe, and European refinery utilization has been going up from the low to mid-70s several years ago to 87 to 90% here in 2015. And of course, that impacts the Atlantic Basin ability to supply more gasoline to the increasing demand here in the U.S., which is set to be a record here in 2016. We're well on our way to do that. But ironically, the refining industry here in the U.S. is going in the opposite direction of making gasoline. It's actually making less gasoline with a variety of cat cracker shutdowns. We're seeing in 2015 Valero Moreau shut down. And as we go through 2016, Motiva will be shutting down its Convent cat cracker as they integrate the Norco and Convent refineries. Marathon Galveston Bay has announced that they're shutting down their very old 60,000 barrel a day cat cracker. And in 2017, Tesoro Wilmington, as part of their consolidation of the Wilmington and Carson refineries, will shut down another 36,000 barrel a day cat cracker. And the sum of these four cat cracker shutdowns is a loss of 150,000 barrels a day gasoline. So gasoline demand here in the U.S. continues to grow. At the same time, we're losing the ability to make gasoline here. So the difference is going to have to come in from imports, or the industry has to figure out how to tweak some of their other downstream unit capacities. On the other hand, on distillate, as we've been shutting down the gasoline-making facilities, we've been adding hydrocrackers that are predominantly adding distillate to the supply mix, whether it's Valero or Calumet or the potential restart of a hydrocracker at PBF and Chalmette with expansions at Convent and Carson. All of these hydrocracker expansions are going to gain us another 65,000 barrels a day of distillate production at a time where we're seeing distillate demand slightly growing to rather flat, but one can clearly see in the EIA inventories how we're at 160 million barrels coming out of the winter. Certainly this high level of storage and inventory is impacting on the distillate cracks. So I want to move on and look at what's going on in the Ohio Valley, because as I mentioned, increases in refining capacity and pipeline logistics that's going on in the Ohio Valley has had an impact on margins in Ohio and Illinois, and it's moving that product over to the Pennsylvania market. So if we were to look at this pictorially, I always like looking at a map. What we've seen, first of all, is increased production, whether it's out of the Marathon refinery system in Detroit, which over the last 4 years has added 50,000 barrels a day of capacity. At Canton, they've added another 10. At Catlettsburg, there's another 30 that they've added. And if one recalls, back in first quarter of 2015, the Husky hydrocracker had an explosion that took 26,000 barrels a day of product out of the Ohio market. That hydrocracker is expected to come back online here in the end of the second quarter after they finish up their turnaround. Well, with all this additional capacity, the system has to figure out a way to get it out of the area, and that's done with a number of these pipelines. And what we've seen is the Sunoco-Allegheny Access Pipeline came on stream in 2015, adding 85,000 barrels a day of space into the Pittsburgh market. We have two projects, the Wolverine Detroit Access Metro project, which is going to add about 90,000 barrels a day of capacity, getting you from Chicago to Detroit. At the same time, that Buckeye is building a pipeline system to go from Detroit in Ohio over to Pennsylvania with another 65,000 barrel a day of capacity. And this will enable even more oil to make its way to Pittsburgh. Well, if you're putting more oil into Pittsburgh from the west, then it's going to back out petroleum products coming into Pittsburgh from the east, namely those Philadelphia area refineries, or really in turn reduce imports into New York Harbor. So as a result, we're having a change in dynamics, and you're seeing this in the prices of Laurel pipeline gasoline versus New York Harbor prices for gasoline as more product makes its way into Pennsylvania. At the same time, nationwide refining capacity utilization is going up, and we're just turning more crude oil into products as crude oil remains on sale. So I want to briefly talk about RINs. There's, at least in my mind, been a change in philosophy of what's going on in RINs and what's in the RIN bank and when we may run out of RINs. As I look back over the last 4 years, what we've seen is the EIA gives to the EPA their estimate of gasoline and distillate demand. And for the last 4 years, they have understated what the actual demand is. But based on what their assumptions are, the EPA turns over a percentage for the obligated parties for the renewable fuel standard. So, for example, in 2016, roughly 10.1% of every gallon of gasoline and on-road diesel, including locomotive, marine, and all that business, is required to have RINs attached to it. If the EPA and the EIA underestimate actual demand, we are going to consume more RINs because we have to meet the increased demand for gasoline and diesel. So as a result, what we're seeing is a greater demand on RINs just from the fact that gasoline and diesel demand is higher. Another area that's more subtle, which is creating demand, is from ultra-low sulfur diesel going to ocean-going vessels. Ocean-going vessel diesel consumption is actually exempt from the Renewable Fuel Standard Program. However, because refiners and importers can't track every molecule of ULSD that's coming out of their refineries, they're actually buying some RINs to cover this ULSD, not knowing that some of it may ultimately go to an ocean-going vessel. And as a result, that means we're creating even additionally more demand for RINs. And what we've now seen is a gradual drift up in prices of RINs because the perception is now beginning to change that we're going to dip into the RIN bank in 2016 and 2017 a little bit more than we expected. If one were to look at the RIN price for last year, it averaged about 55 cents a gallon for an ethanol RIN. Today, year to date, we're already at 71 cents, and today's market, we're now ticking on up to about 75. So the market's perception and the demand for RINs can ultimately be impacting on refinery margins as we go forward. And if one were to look at the NYMEX cracks for both gasoline and diesel fuel, even though they appear to be quite robust for gasoline and still under pressure for ULSD, these are products that have a RIN price embedded in it. So the actual crack for a refinery is now running about $3 a barrel less than what you might see on the screen. So that's another thing to consider, especially in the first quarter when we saw refinery P&Ls really getting hammered, and the stock market certainly didn't take kindly to refining equities as they saw these earnings come in. So to kind of summarize, I've spoken about a variety of topics here, but prompt crude remains on sale. There's still a lot of it out there. The OPEC freeze really didn't take any supply off the market, but my target for WTI is $50 by January 2017 as we see production in the U.S. continue to decline at the same time that world oil demand has been increasing. If we look at what's going on the gas cracks, if one really wants to be bullish refining, we've got to pull down about another 10 million barrels of gasoline over the next couple of weeks. So the market says we've got great demand and pretty good supply, but we're not really willing to tolerate very many supply disruptions, whether it be from refineries or an upcoming hurricane season. The diesel side of the equation, to me, looks really quite bad. There's still diesel everywhere as refiners come back from maintenance over the next couple of weeks and add about 700,000 barrels a day capacity back online. We're just simply going to get more diesel oil out of the system. And the same can be said for what we're seeing out of refineries in Asia and Europe as we all scramble for outlets to put the diesel. And finally, on the RINs demand is higher than the market thinks. This is going to force prices to drift on upward throughout 2016 and into 2017. So with that, I'm now going to turn over the presentation to John Auers from Turner Mason. And John, I'll let you take it away.
Thanks, Andy. Some good stuff there. For my part, I'll be following up on some of Andy's themes, focusing on the global competitiveness of the U.S. refining industry. We've seen a lot from this guy over the last few months, and considering the results of the New York primary on Tuesday, we can expect to continue to hear a lot going forward. We know he likes winning, thinks the U.S. is not doing enough winning, but the fact is, the U.S. refining industry has been doing quite a bit of winning recently, especially versus their competitors in Europe, Japan, and Latin America. Although to some extent the winning margin has been reduced a bit recently in the falling stock crude market. Let me start with the basics and discuss what determines who wins in the game of refining, which is in the end all based on which plants are the most profitable. In this slide, I identify some of the key factors using color coding in red, with red showing those key competitive drivers which refiners have essentially no control over, and green signifying actions that refiners can proactively take to improve their competitive posturing. Obviously, the refined product supply and demand environment is important. Refiners can't do a whole lot about refined product demand growth. They're basically stuck with whatever the market gives them. They're also captive to the prevailing regional competitive environment. But what they can do is make operating adjustments and investments to shape their product slates to produce some more valuable and in-demand products. They've been doing that over the last few years, investing to make more diesel, building the hydrocrackers that Andy noted while shutting down gasoline-centric cat crackers. Now that gasoline demand growth is starting to exceed diesel demand growth in the current low-price environment, they're modifying operations to make more gasoline to the extent they can and contemplating investment to do the same. Refiners can also make investments to increase access to markets with more attractive supply-demand balances, an example of which are the high-value logistics projects Andy discussed. Location is also important as far as feedstock supply dynamics go. Refiners who are located close to prolific crude production basins are certainly advantaged compared to those that have to incur significant transportation costs for crude supply. U.S. refiners in the Mid-Continent, the Rockies, and Permian Basin were particularly advantaged in recent years as strong light tide oil growth exceeded regional exit capacity, and they experienced double-digit discounts in their crude supply costs. Advantage access to other feedstocks can also be important. Here's where Gulf Coast refiners realize some benefits in their ability to trade intermediates such as cat feed and naphtha, and refiners that have advantaged access to natural gasoline, isobutane, ethanol, and other important feed and blend stocks can also enjoy supply cost benefits. What refiners can do to improve their competitive position is make investments to be able to efficiently process the changing quality of the crude that is being produced. Examples of this are the investments refiners in the Mid-Continent and Rockies have made in improved metallurgy and adding new cokers and support facilities to be able to run heavy and high-tan Canadian crudes. Similar investments in coking capacity made by U.S. Gulf Coast refiners to first run Mexican and Venezuelan heavies and more recently Canadian heavies as well. With the rapid growth and production of very light crudes and condensates coming from the light tide oil basins, refiners with access to those crudes have been making investments to be able to efficiently run those barrels. Much of this investment has taken place in the U.S. Gulf Coast, as Andy showed on his slide earlier, primarily targeting Eagle Ford, but refiners in the Rockies, Ohio Valley, and other regions have also spent capital to process growing volumes of Utica, Uinta, Bakken, and Permian crudes, among others. Investment can also be made to improve access to advantaged crudes, and the capital spent for this has often been even greater than for processing facilities, as not only pipelines have been built to overcome takeaway limits, but also significant investments have been made in rail and marine facilities to allow refiners on all three coasts gain better access to growing volumes of light tight oils and heavy Canadian crude. Operating costs are also an important line item in manufacturing operations, and certainly natural gas is the most important variable cost in a refinery. It's used to generate process heat, also used to produce the hydrogen necessary for many refining processes. The boom in shale gas production has led to lower prices, a major advantage for U.S. refiners compared to their competitors in Asia, who have to rely on expensive LNG, and Europe, where refiners also have to bring in LNG and expensive and potentially unreliable Russian gas. Size and scale are always important when it comes to operating costs, allowing refiners to decrease per barrel operating and overhead costs. The expansion's costs depend on market product demand and available crude supply. One avenue to increase size is through acquisitions, and often mergers and refinery purchases are largely justified by being able to reduce redundant costs both at the refinery and at corporate levels. Refiners can also invest in projects to increase operating and energy efficiencies. And certain refiners who do a better job managing costs become more successful in the game than the guys who don't. And last but not least, the regulatory environment which refiners operate can significantly impact their success or lack thereof. Location is also important here, as regulations vary not only from country to country, but from state to state and even from municipality to municipality. These regulations can impact demand in a negative way. They can increase costs, they can limit access to supply, and they can impact the ability of refiners to execute projects in a timely and cost-effective way. While refiners can't change where they're located, they can at least attempt to limit the damage of new regulations by helping to mold legislation through lobbying efforts. Much of this requires educating policymakers regarding the true costs and benefits of proposed rules and regulations, an effort we as a firm have been heavily involved in over the years. Ultimately, more stringent environmental safety regulations will continue to be enacted, and the most successful refiners will be those that make wise decisions regarding compliance strategies, which can include making targeted investments which minimize compliance costs. So now let's look at demand. Over the past 10 years, essentially all the demand growth has taken place in the developing countries. Total world refined product demand has increased by 9.2 million barrels a day over that time period, which includes the impact of the global recession in 2008 and 2009. As a result of decrease in demand during the recession, but also structural factors such as stagnating population, saturation of auto markets, other demographic factors, and increased use of alternatives, the developed countries actually saw a decline of 4.5 million barrels a day of product demand since 2005, with the U.S. share of that demand decline equal to about 1.4 million barrels a day. At the same time, demand in developing countries rose by almost 14 million barrels a day, led by China, but with significant strength in many other regions. Now, we've seen a bit of a change recently in demand growth in response to lower crude and product prices, as Andy noted in his remarks. Product demand is elastic, particularly gasoline, and consumers do respond to lower prices by increasing consumptions. Of the 1.4 million barrels per day of global demand growth estimated by EIA in 2015, fully 45% came from the U.S. and Europe, mostly in the form of gasoline. At the same time, we've seen slower growth in producing countries where low crude prices have negatively impacted their economies. The demand response to low prices in many other countries has also been muted as a result of some governments taking the opportunity to reduce subsidies or increase fuel taxes in a lower-priced environment. In the U.S., on a regional basis, it's kind of the same story, with most of the 1.4 million barrels per day of demand decline in the U.S. over the last 10 years coming on the East Coast as a result of negative regional demographics and sluggish economic performance. Demand also declined in the Mid-Continent and the West Coast for similar reasons, whereas demand growth was positive, although minimal, on the Gulf Coast and the Rocky Mountain states, where the general economic climate was better. This was in part aided by a more favorable regulatory environment and benefits from strong growth in the energy sector in those regions. Again, similarly to what happened on a worldwide basis, regional demand patterns have temporarily reversed in the U.S. as prices have fallen. Demand on both the East and West Coasts have bounced back strongly in response to lower consumer prices, while these same low prices have negatively impacted the oil industry, which is an important part of the overall economy in PAT 3, 4, and parts of PAT 2. Refineries naturally get built and expanded in response to demand growth, and capacity is rationalized when and where demand declines. On a global basis, over the last 10 years, net refining capacity increases of about 11 million barrels per day have fairly well matched the 9.2 million barrels per day of demand growth during that same time, when you consider normal utilization rates. As you would expect, most of the capacity expansion came in regions where demand was growing. But 80% of the total capacity growth took place in the developing countries of Asia, where total refining capacity increased by an astounding 60% just that last decade. The Middle East has also added significant capacity, as did Russia, while over 2.5 million barrels per day of refining capacity was shuttered in Europe and developed Asia, with perhaps another 2 million barrels per day under threat. The Western Hemisphere has proved to be an exception to these trends. While demand growth in Latin America was relatively strong, actual capacity went down, and when considered utilization rates, their effective capacity went down even further. At the same time, contrary to what happened in other OECD countries, the U.S. actually added 900,000 barrels a day of refining capacity, even while demand fell by the 1.4 million barrels per day I noted earlier. So why did this happen? Why did the U.S. refining industry go against the trend? The reason is that it increased its level of competitiveness compared to global rivals. As Donald would say, we are winning. Perhaps the most fundamental factor facilitating this winning, and which positively influences most, if not all, the other key factors, is the free market environment in which the U.S. refining industry is allowed to operate in. Maybe it doesn't appear so at times, but the U.S. is also more economically and politically stable than our global competitors. Big plus for any business. But that hasn't always been the case. The U.S. had some pretty misguided energy policies in the 1970s, where the price refiners paid for crude is controlled through a complex system of new and old oil, and which led to a very bloated and inefficient refining system. When I began my career in the business after graduating from college in 1980, the U.S. had over 300 operating refineries with an average capacity of less than 60,000 barrels per day. A lot of these were basically living on subsidized crude. When Reagan deregulated oil markets by removing the price controls early in his first term, it was painful for many years for the U.S. refining industry, and over 180 refineries were shuttered over the next 3 decades. But going through this Darwinian survival of the fittest process has in the end been very good for the industry. As the herd was thinned and weak plants were shut down, the remaining facilities evolved into lean and mean refining machines. Total industry capacity has actually increased, exceeding 18 million barrels per day currently, resulting in average plant capacities that more than doubled to 130,000 barrels per day. The U.S. industry has the most advanced and complex set of refineries in the world, with significantly more delayed coking and gas oil cracking capacity, percent of crude capacity, than any other region. This allows U.S. refiners to run heavier and more difficult to process crudes and turn them into more highly valued products at higher yields than refiners in other regions of the world. We also have the deepest and most talented and experienced refinery labor pool in the world, all the way from management through the technical ranks and down to the skilled and hourly levels. Combined with more flexible employment work rules than exist in many countries, particularly in Europe and Japan, this allows U.S. refiners to run their plants more reliably and at higher throughput rates and lower operating costs despite relatively high wage rates. It also allows them to execute capital projects and perform maintenance activities more efficiently and at lower costs. Almost without exception, you can make capital improvements to refineries on the U.S. Gulf Coast cheaper than anywhere else in the world. And to put the final frosting on the cake has been what's happened in the upstream segment of the business in the last few years, with the boom in shale gas leading to lower energy costs for U.S. refiners, and the light tight oil boom providing them advantaged crude costs. Let me now take a close look at how those last two benefits have evolved. The ability to extract natural gas from shale formations has been a real game changer in the U.S., moving us from an anticipated shortage to a growing surplus. This has resulted in U.S. natural gas prices significantly below those experienced by competitors in Europe and Asia. Having to import expensive LNG to meet demand, gas prices in those regions grew to double-digit dollar per million BTU levels in the early part of the decade, while U.S. prices remained below $4 per million BTU. As overall energy prices have fallen over the last couple of years, the U.S. advantage has declined to some degree. In this table, I've translated natural gas costs to dollar per barrel operating costs at the refinery level. In 2013, U.S. refiners had about $2 to $2.50 per barrel crude barrel operating cost advantage compared to our European and Asian competitors as a result of lower natural gas costs. This advantage has fallen to generally less than $1.50 per barrel in 2015, a still formidable benefit. Lower relative crude costs are an even bigger advantage for U.S. refiners. Prior to the boom in domestic production, the U.S. imported significant volumes of light sweet crude. These barrels were priced on an import parity basis as a result. This basically meant that LLS St. James was priced on an average about $2 to $5 per barrel premium versus dated Brent. As domestic crude production grew and we started displacing those imports, the domestic premium declined and at times became a discount. Although there was significant volatility from 2011 to 2013, the LLS versus Brent differential actually averaged close to zero. During that same time, regional crude differentials really blew out as production exceeded takeaway capacity in many regions. WTI, Bakken, Canadian, and other inland crudes reached double-digit and even 20 to 30 per barrel discounts or more compared to LLS and other crudes available on the coast. Refiners located in the Mid-Continent, Rockies, and Permian Basin who had access to these crudes realized huge margins. As pipelines were built to the Gulf Coast and rail facilities were added to the east, to a lesser extent to the northwest, refiners in those regions started to reap the supply cost benefits. With almost all light sweet imports on the U.S. Gulf Coast displaced and crude export restrictions limiting market access, the LS discount to Brent exceeded $5 per barrel and even reached double digits for a short time in late 2013 in what appeared to be a move to a permanent discount. But the dynamics changed again as falling crude prices first slowed and have now led to decreasing domestic production. The discount gradually disappeared, aided to some degree by steps toward export liberalization, and has recently moved towards import parity levels, with the LS versus Brent spread averaging about $1.30 per barrel over the last couple of months. As I noted earlier, the U.S. industry has been able to execute capital projects more efficiently than their global competitors. Part of this is because of difficulties encountered by those competitors. Building and running refineries is a very complex task, requiring not only experience and talented manpower, but efficient and properly incentivized planning efforts. Many of those elements have been lacking in other parts of the world. The inability of our neighbors to the south and Latin America to build capacity to meet growing demand has been particularly evident. This hadn't been for a lack of trying, as a significant amount of expansion and greenfield projects have been planned and initiated, but many have not gone off the ground and others have encountered significant cost overruns and delays. Much of the problems relate to the sponsorship of these projects by government-controlled companies, with accompanying issues of confused and conflicted politically directed planning, incorrect staffing, corruption, and in many cases simple incompetence. I've highlighted some of the more prominent projects here, knowing the overruns and delays. Some of the biggest problems have been encountered by Brazil, a large consumer of petroleum products in Latin America and the second largest destination of U.S. product exports. Two of the largest involve the Petrobras-sponsored Abreu, Lima, and Camperjé refinery projects, both of which have encountered overruns running north of $10 billion and multi-year delays in each case. While part of the Abreu, Lima facility did actually start up, the Camperjé project appears years from being ready to operate, even after billions of dollars in expenditures. Not shown on this list are projects from Mexico, the biggest recipient of product exports from the U.S. Pemex has plans for years to decrease this dependence by building new refineries, but not only have those plans been shelved, but their existing refineries have experienced operating problems and low utilization rates. Whether potential privatization and the new energy reform helps or even happens is something to watch for in the coming years. Also not shown are projects in Venezuela, simply because none have been advanced. At one point, the national oil company, PDVSA, was the most efficient national oil company in the region and probably the world, and Venezuela was a big product supplier to other Latin American countries. Since the change in the regime and the 2002 and 2003 strike, it has become a shell of its former self, losing thousands of skilled professionals and operators, and the refineries are experiencing very poor reliability and utilization rates, actually having to import refined products at times. And it's not just consuming countries that have had overruns and delays in adding refining capacity, but also potential competitors for export product markets, such as these projects in the Middle East. While a few have come online in the last few years, such as the Aramco JV plants in Jubail and Yanbu, and the Takrir plant in UAE, delays were experienced and the cost for all these projects exceeded budget estimates and cost much more than similar facilities would cost on the U.S. Gulf Coast. I will say that the one place in the world where refining projects have been built at cost and schedules competitive with those on the U.S. Gulf Coast has been in India, as executed by private companies Reliance and Essar. The free market environment in the U.S. has not only led to more complex and efficient refineries, but has also driven a restructuring of the industry to a more competitive, profit-centered model. The industry has gone from 60% capacity being controlled by major integrated oil companies in 1994 to one where 70% is now owned by independents. Consolidation has also taken place, leading to improved economies of scale and better intercompany synergies, as the top 10 companies have increased their share of U.S. capacity from 50% to 70% in the last 2 decades. But both of these developments have led to more efficient operations, with the companies becoming more price responsive and deploying capital more efficiently. The increased competitiveness of the U.S. refining industry has led to a huge change in refined product supply balance between the U.S. and the rest of the world. The U.S. had for a long time been the world's largest importer of refined products. By 2006, the net product deficit had reached levels of 3 million barrels per day. But this situation has changed dramatically over the last 10 years. As domestic demand fell, U.S. refiners were able to compensate by dramatically decreasing imports and increasing product exports. Much of the exports have gone to Latin America, filling the growing refined product gap in that region as a result of supply and demand issues I'd already mentioned. In 2011, the U.S. became a net product exporter and is now growing to be the world's largest exporter of refined products, with net exports currently exceeding 2 million barrels per day. This is a turnaround in the product balance of around 5.5 million barrels a day, and as Donald would say, that is huge. But is there a limit to how much refined product the U.S. can export, and are we approaching that limit? Taking a closer look at net export numbers over the past couple of years could lead one to think that the answer might be yes, as the balance seemed to be leveling off beginning in 2014. But much of this was in fact due to growing domestic demand, and late in 2015, net exports seemed to have taken another step up, hitting a record of over 3 million barrels per day in December. Recent weekly numbers have been mixed, and we will be following balances closely to the remainder of the year to see if export demand growth can continue. The U.S. is a big place and is by far the most refining capacity of any country in the world. Both crude and product supply and demand dynamics are very significant on a regional basis throughout the country. Refineries in PADD 1 are certainly the most challenged, in large part because they operate in a very competitive Atlantic-based environment, with U.S. Gulf Coast, European, Canadian maritime plants, and now even plants from PADD 2 all fighting for a share of the market. With essentially no crude production and no pipeline access, they have a disadvantaged crude supply situation, which is made worse by the Jones Act. The recent removal of crude export restrictions has added to this disadvantage, with the European refiner now potentially able to source a barrel of crude from the Gulf Coast cheaper than a U.S. East Coast refiner can. These disadvantages have led to a net decrease of 500,000 barrels a day of capacity over the last 10 years, and only the build-out of rail access to LTO and Canadian crude has saved some plants. Refiners in PADD 2 benefited the most from the LTO and heavy Canadian crude-driven surplus, experiencing significant supply cost discounts. As I noted, a lot of that advantage has gone away as pipelines have been built to move that crude further down the line. PADD 3 is very large, both in area and refining capacity, and as a result, there's significant variability across the region. Inland Texas and Corpus Christi plants with best access to growing Permian and Eagle Ford production were the winners early on, but build-out of infrastructure has spread those benefits further east to Houston, Louisiana. The U.S. Gulf Coast as a whole has been a big beneficiary of the growth in exports, but the caveat here is that they've become quite dependent on them as well, with more than 35% of the refined products turned out by PADD 3 refiners now going to export markets. PADD 4 is by far the smallest refining market, but at times has been the most profitable. This is as a result of both beneficial crude supply and product demand dynamics. The lower price environment has negatively impacted both of these, but longer term we believe those benefits will return. Regional refineries are somewhat disadvantaged, however, and they're small and relatively isolated, limiting available synergies with each other and also limiting expansion opportunities. Back in the good old days, when California's population and economy were rapidly expanding, PADD 5 was the most profitable place to be a refiner. And because of the Exxon Torrance FCC outage last year, some of these good times have temporarily returned. However, structurally, while the potential for strong margins remains because of the isolated nature of the region, the environment has generally changed for the negative. To a large extent, this is related to the challenging regulatory environment in the state of California. This not only increased the cost of doing business, but it also led to a stagnating economy and declining refined product demand. This in turn has caused the region to move from a small product deficit to surplus when all refineries are operating. The crude supply environment has also taken a turn for worse as local crude production has declined while access to light tight oil has been limited, in large part due to difficulties in the permitting of new midstream infrastructure. And did I mention, California is a challenging regulatory environment. Let me highlight a few recent developments in the regional refining landscape. On the West Coast, the impending startup of the Torrance cat cracker will certainly increase gasoline supply and be bearish for West Coast margins and other refiners that supply the West Coast. On the Gulf Coast, the divorce between Aramco and Shell and the Motiva joint venture is certainly big news. While we don't expect significant changes in the operations of the refiners involved in the short term, what this means for future moves by both companies regarding their U.S. operations is being hotly debated. In PADD 1, as the domestic discount has disappeared and the Bakken basis differential has shrunk, crude imports are increasing. While Bakken is still being delivered by rail, that is being done to satisfy volume commitments, as Andy talked about, not current spot economics. In the Midwest, refiners have been trimming runs in reaction to bulging product inventories, providing an example of market responses that I mentioned earlier. Runs this April about 10% below where they were last year. What does this all mean for refining margins? This slide provides a look at our estimates for those margins over the past 15 years in the U.S. The so-called golden age from 2005 to 2008 was a culmination of many years of rationalization and low prices, which led to demand overtaking supply and the best margins refiners had ever had. All regions of the U.S. did well, although the East Coast did lag. The financial crisis brought the golden years to a halt. The golden age, too, for the U.S. industry came as a result of the light tidal boom, with Mid-Continent and Rocky Mountain plants realizing exceptional margins as a result of the gigantic regional crude discounts. And other regions also getting a bump for lower-priced domestic crude and natural gas. Build-out of midstream infrastructure and slowdown and decline in domestic production brought an end to most of the crude discounts, but low price-driven demand growth provided U.S. refiners very good margins in 2015. West Coast plants did particularly well because of the shortage of gasoline supply resulting from Torrance outage. While West Coast margins remain healthy, margins in the rest of the U.S. have come down so far this year, partly due to seasonal factors and partly due to regional product surpluses. I believe strong gasoline demand and the adjustments refiners have made to run rates will improve margins as we move into the driving season, obviously with the exception of the West Coast after post the Torrance startup. The winning that the U.S. refining industry has been doing is quantified on this slide, comparing the weighted average U.S. margin with that of competitors in Europe and Asian refining markets. The gap has been closing since oil prices have fallen as a result of the decreases in the U.S. crude and natural gas cost advantages, and also due to demand-driven improved margins in Europe and Singapore. While U.S. refiners retained a healthy lead in 2015, that lead has disappeared in the first quarter of 2016. Refining, I guess we skipped that one. I'll skip the slide here then. Let me close out with some final thoughts on some key issues. In regards to the potential of crude prices staying lower for longer, that certainly doesn't bode well for the upstream and even the midstream segments, but the potential prospects for refiners in such a scenario are much more complex. On the positive side of the scale, low prices stimulate demand, provide higher margins on products not closely linked with crude, such as asphalt and lubes, and dim the prospects for alternatives. On the negative side, they've caused the domestic crude discount to go away and compress natural gas cost advantages. Prospects are also regionally specific, as refiners where oilfield activity has slowed have seen negative impacts on their markets as well. Because of the changing market environment, the lifting of crude export ban in December came off not as a bang but a whimper, and we expect to see relatively few exports until domestic production growth resumes. Longer term, it will limit the domestic crude discount to an export parity relationship, and it does remove the incentive for crude to product driven projects which would have otherwise been necessary in an export ban constrained world. Regulations will continue to be an important part of the profit equation for U.S. refiners. Among the more important issues for refiners include the Tier 3 gasoline rules, which go into effect at the beginning of 2017, proposed lowering of the ozone standard to 70 parts per billion, the midterm CAFE corporate average fuel economy standard review currently in progress, proposed more stringent process safety management rules in California, the possibility of increased octane requirements, ongoing permitting issues, and the annual setting of renewable fuels obligations. What happens in the 2016 elections, both at the national and state level, will certainly impact how some of these and other rules get implemented. Product demand as always will be key, both domestic and global. Skip that. We had a slide out of order there. We'll just skip that. But product demand as always will be key, both domestic and global. One thing to really keep an eye on is the relative demand growth of gasoline versus diesel. Certainly in 2016, it appears that gasoline will attain the leadership. We can expect a record year for gasoline demand if the last 3 months are any indication. At the same time, the diesel market looks like it will remain weak in the short term, although we see some potential tailwinds going forward, particularly the implementation of the low sulfur bunker rules planned for 2020. In the end, we believe the U.S. refining industry will continue to be a winner, although there are challenges aplenty. At the same time, although they've enjoyed a temporary respite, I believe the refining markets in Europe and developed Asia can expect to see more pain and capacity rationalization in the future. You've heard enough so far from the consultants. Let's turn it over to somebody who's actually a direct participant in the U.S. refining industry. Mark Smith, the Executive VP at Delek. Your shot, Mark.
Thank you, John. I appreciate it. Okay, for anybody who's still with us here at the 4 o'clock Eastern, 3 o'clock Central Time, if you go to my first slide, I actually had to go back into my technical analysis of fundamental markets book, or financial markets book, and I looked at page 1065 and found my old favorite John McEnroe, Jimmy Connors technical chart here. And what this chart shows you is that we've kind of been in this back and forth volley of prices. And as you know, most of us traders out there, we kind of get bored of all this. And I think we've seen this little bit of rally up here, almost to $44, and off our $26 lows, and we're still waiting for a breakout though. So this volley's going back and forth, and hopefully we can you know, maybe get McEnroe to smack one over the net and get us to at least go in one direction or the other to provide a little bit more excitement to this market. I'm not really going to go over this slide for everybody because everybody can read, but basically what I'm going to kind of try to do is after my two friends John and Andy have talked about, I'm going to try to dispel the reports of the death of U.S. refining. May have been greatly exaggerated, at least in the near term. We're going to talk a little bit about what goes on, what supply demand has been looking like, and kind of now we're beyond the shale revolution. So we've gone through the golden age, we've gone through the shale revolution. Now all of a sudden somebody's going to have to come up with a new moniker here for the next couple of years as we move into a new world and hopefully continued good U.S. refining margins. As we move to my next slide on the outlook, you know, we've had a lot of changes here in 2016, both legislative and operational, that have really had an impact, you know, currently on refining margins and operations and going into the future. We've had the lifting of the crude oil export restrictions, which is provided as the government does at all times. It was done at the you know, the perfect time when basically, you know, production starts to decline and exports and arbitrages come in and exports aren't really needed. But anyways, we have also the Panama Canal expansion and then some continuous rulings. One of the ones that I don't think everybody's aware of is the U.S. Customs ruling, which kind of has allowed folks to export blending components and then kind of blend them somewhere else and bring them back on foreign flag ships, which allows for a little bit cheaper imports, although still it's pretty costly to do all that. And then the RINs, obviously, as both Andy and John even mentioned, RINs have had a big impact on what is going on in the market these days, and I think they'll continue to play an important role in both margins and how products are traded around the U.S. If we go to my global supply and demand balance, I mean, these graphs obviously, because numbers are big now. You know, when you get up to almost 100 million barrels a day of demand globally, you know, charts get pretty thick. But basically, what this chart kind of has said, and it kind of shows you if you really look into them, is that, you know, global diesel demand still continues to grow a little bit slower than it was you know, previously, and we have had a little bit of resurgence in global gasoline demand, obviously in North America with lower prices and you know, the U.S. consumer really getting excited about $1.89 gasoline. But it's still, I think, long term, and I think long term most refiners still believe that at least the North American gasoline demand story is a short term kind of pop, and we believe that over the long haul, you know, global distillate demand will still lead the global products markets. As we continue to talk about refining capacity across the globe and across the U.S., you know, people still are investing in refining capacity across the globe, with a lot of new refineries in the Middle East and Asia coming online, but they're still really geared towards distillate supply. So as global gasoline demand continues to grow with China, it appears that China is really, their infrastructure is going to be focused, their cars and automobile industry is going to be focused more on gasoline than their European counterparts who kind of converted to distillate automobiles, and same in India. And so I think as we see, global gasoline demand will at least continue to grow in the Far East, which should allow a competitive U.S. refining industry an opportunity to really be the main supplier of that globally, at least the cheapest supplier of that for sure. And what we've seen recently here in the U.S. and you can kind of see the disconnect on RBOB gasoline prices as a percent of Brent. I think everybody remembers back in 2012, 2013 that we had really good U.S. gasoline cracks. And they were highly correlated to the Brent TI spread. Obviously, you see that we're still having pretty good gasoline cracks as we enter the summer here. But as John and Andy pointed out, the Brent TI spread isn't $12 anymore. So we still have we've seen that correlation disconnect. But then, as a percent of Brent, we've seen it at pretty much record highs. So what do we do beyond shale? So now that we've kind of passed the shale revolution on the production side, everybody has kind of seen this, and this is what has caused, I think, the price drop over the past year and a half. And then actually some of those graphs that are on this slide contribute to the price increases we've seen recently in the last, say, since mid-Feb. I won't say it, but it looks like, as I look at my chart, the low might have been very close to my birthday, so I'm not sure if that's any correlation there. But, we've seen production increases year over year be very significant in 2014 and 15. And as we had the demand decrease and oil prices continue to have their very suspicious decline down to the $28 range, we saw that production fell also as we entered into 2016 and 17. And we can see in the forecast there, EIA has kind of shown, shale reached up to almost a little over 5 million barrels a day, and it started to come off, and you can see it kind of leveling off. But I think where traders and where prices exist is that the fact that it is leveling off, maybe declining for a little bit for maybe the next 6 months to a year, that difference between those huge year-over-year increases that we saw, from 2010 through 2015, I think that really is the reason for our kind of bottoming out in oil prices, and as we start to head back up, maybe towards the $50, as Andy said, by the end of the year. As we get to Canadian production, our friends in Calgary, I'm not sure if any of our friends in Calgary are on the line today, but things in Calgary aren't as exciting as they were, back in 2014. There's been a lot of capex cuts, billions of dollars in these large projects up in Alberta, and one of the effects of that's going to be is that over time, and you're not going to see it maybe this year, and you'll start to see it maybe in the next few years, is that Canadian production is going to start to decline, and we're not going to get that huge increases as there's going to be a pretty big gap in these large projects since people have either deferred them or canceled them over time. So that's going to put some pressure on the WCS WTI spread, where we should, it's going to be very difficult. I think there's going to be a lot of demand for the heavy Canadian as the pipeline capacity is opened up into the U.S. For Canadian crude. I think I saw today that Enbridge, reported even some of the Canadian crude getting into the U.S. and into Cushing and down into Houston. Their pipelines were not allocated this month. So we're already kind of seeing what used to be a hugely allocated pipeline system coming out of Canada is now less allocated, and therefore I think that keeps Canadian differentials, fairly strong, over the near future. Midland, obviously Delek is a huge Midland player. We were kind of probably one of the biggest beneficiaries of the huge differentials between Midland and WTI created by the logistics constraints out in the Permian Basin. And as you can see from this graph, Midland pipeline capacity has now kind of exceeded the flows and the production out in Midland, and so you're seeing those differentials that Andy talked about, where we're seeing -50, -60 Midland in Midland, and then by the time it gets to Houston and you have to pay shipping tariffs, you're not really getting the same value for that crude in the Houston area. So I think this kind of just shows you how infrastructure gets built out. Pipelines, 400,000 barrel a day pipeline can't come on at only 100,000 barrels a day on day one. So when people build these new pipelines, you'll get these kind of gaps in pipeline flows versus production. But I think as prices do recover, the Permian Basin is obviously the lowest cost market or lowest cost basin in the U.S. And I think most folks have their eyes set on continuing to produce in the Permian Basin, and I think we'll see differentials make their way back towards the pipeline transportation costs. So that's the stuff that Andy had mentioned, the $2 to $3 type transportation costs to the Gulf. I think over time, and obviously I'm not going to give you a price and a time. So over time, and I can't tell you when that time will be, we see economically prices kind of moving back to their transportation equivalents. So I think John, kind of hit on these topics here, and what are, U.S. refiners still have a significant structural advantage over our world global competitors, and now with the fact that we can still have low, cheap natural gas. I don't see natural gas prices changing that much. We continue to find more gas and produce more gas. So the U.S. refiner, which is a huge cost to the U.S. refiner, is going to have a natural gas advantage. We have infrastructure advantages and complexity advantages that the rest of the world does not have. And even though I will say shale production growth is down and maybe declining a little bit, we still produce a significant amount of really cheap oil compared to the rest of the world, and that's going to give the U.S. refiners a major operating cost advantage, and will further be able to continue to compete on the world stage for both gasoline and distillate exports. And I think one of the interesting things, if you look at the EIA statistics, is there really hasn't been a significant, even with all these the crack spreads being significantly lower in the first part of the year, there really hasn't been a significant decrease in global export or in U.S. exports to the rest of the world of products. Obviously, one of the kind of things that have driven this lower crack spread environment is that our demand growth and supply growth have kind of been a little bit lower than we expected. Global demand's been a little bit off, probably due to less drilling in the U.S. and a little bit of less growth in China than folks expected. But I think we got to remember that 7% growth in China today is probably way bigger than 15% growth in China it was back in 2005 or 6. So we got to kind of keep that in our forefront. Crack spreads. I mean, I think we saw Gulf Coast gasoline cracks be pretty weak, pretty early in the year, and into the fourth quarter of last year, and it's kind of seen through all the refinery earnings. We've seen obviously that kind of summer bump. I think octane shortage is still there this year, and we've seen gasoline cracks return to a pretty decent level here in the second quarter and going on. The story, I think, for most people, what most people have been talking about, including John and Andy, is on the distillate side. We had pretty consistent $20 distillate cracks for a long time on the Gulf Coast, and we've seen those deteriorate over the past year and a half down to $10, $11. I kind of always, obviously global distillate demand is off a little bit. U.S. distillate demand's off because of the lower drilling, but I really do see that probably we still see that there is demand for distillate. Growth may have declined for a little bit, but we'll see the return of global distillate demand growth. And with the U.S. competitive position where it stands, I think that provides us U.S. refiners with a pretty good advantage over the next few years. I'm going to just kind of focus a little bit on what Delek's been doing with all that background of what did we do in the shale revolution and what are we kind of doing forward. And for people who don't know, as Andy put it, I think Baby Refining Inc. We're a very small refiner, 2 refineries, both about 75,000 barrel a day refineries. One's in East Texas, one's in El Dorado, Arkansas. We're the only refinery in Arkansas, if anybody cares. And we basically spent the last couple years, and we have very high connectivity to the Permian Basin. We also have, through our logistics company, have connectivity to the Gulf Coast through a pipeline called Payline, which originates in Longview and heads into the Phillips 66 Nederland terminal. So we have pretty good connectivity, especially to the shale basins, and that really provided us some real good cost advantages over the past few years. The other things on the product side that we have is we're in very good niche markets. So our products, there's very little competition in the local, say 40, 50 mile radius of our refinery. So we have really good local niche markets to provide products in, and we've run our refineries really well to keep up with the demand in that area. On this slide on our investments, what I really will point out here is that we've made the investments in the 2 refineries to process more light crude to take advantage of the shale markets, and we really don't have any significant refining capital expenditures till our next turnarounds, which are late 2019 and 2020. We also have an MLP, just like all of my other friends in the independent refining industry, where we have a logistics MLP that really provides us that vehicle and access to capital to grow logistics, both on the products and on the crude side that help enhance our refining business. Retail side of the business, nobody talked about retail today, but retail obviously has had a great 2 years. With record contributions because of the decline in prices and the increase in demand by our consumers. So retail is a real good diversification of earnings for Delek, in the system. And as most people know, we acquired 48% of Alon, which is another small independent refiner that looks very similar to us, with 2 refineries about the same size, and we acquired that last year. And look forward to continuing to work on that investment, and as our CEO says, we're most likely not just investors in a small refining company. And we'll talk a little bit about our conservative cash focus, but it's really we have a conservative balance sheet which allows us to take advantage of things like are going on today. When the market's down, these are the times where different investments and acquisitions can really provide a lot of value. This slide here just talks about our local niche markets. So we really serve an area of each of the states that doesn't have real good, necessarily real super good pipeline access or cheap transportation costs to get products to that area. So we're able to, with our refineries in those areas, we're able to serve those guys with product, or maybe our markets might look a little bit like California. I'm not sure. So on our capital spending, this is what I kind of talked about, is that we've done the capital spending that put in the flexibility to process all this light oil. And so now where Delek's positioned going forward beyond shale is we're focused on growth and acquisition. So we're focused on growing our footprint and getting the scale needed to compete. As I think John had a great chart there that talked about how basically, right after I started in this industry, there was a whole lot of companies and a whole lot of refineries, and now, we're down to just a few. So us small independent refiners, we need a little bit of scale to really compete against the Valeros, Tesoros, and Marathons out there. And this just shows what we've done over the past 2 years. So all that money that we made during the golden age and the shale revolution, we were able to utilize a lot of that free cash to reinvest in our assets. And now, as you can see in that far right-hand bar, just on the refining side alone, we're only spending $41 million in CapEx this year at both refineries combined, which really allows us to have a lot of free cash flow to really look at other potential acquisitions and activities in this marketplace. And then here's the final Delek sales slide, and we kind of look at this as a balanced program for our investors, where obviously you've seen we've invested almost $1 billion in the last 4 years in the business. We've acquired 48% of Alon. We have a decent share repurchase program and have a good long-standing dividend policy that allows us to continue to grow and create long-term value, where I think the U.S. refiner is in a great position long-term to really grow value for its investors and for the U.S. population itself. So I think that is it, and I don't know who I get to turn it back over to.
This is Alison. I'll take it from here.
Allison.
Thanks so much to all of our panelists. Just a reminder to everyone who's still on the call, there is a question box. I think it's at the bottom of your screen if you'd like to submit a question. It'd be helpful if you could tell us which panelist your question is for. To start out, we actually have a question from the audience for John Auers asking, John, can you discuss why PADD 4 margins have become negative and whether this is something that's consistent across the region or specific to Billings or Utah?
Well, the number I used there was sort of a weighted average for the whole PADD, and the region is very variable. Billings, Denver, Salt Lake have all their individual dynamics. But in general, and I think I might have mentioned it in my prepared remarks, PADD 4 is a natural resource. Oil, are both very important to the economy of the region, and the decrease in oil field activity has negatively impacted the demand, product demand in the region. Up in the Billings area, similar to up in the Bakken area, some of those refineries were some of the most profitable in the country when they had huge crude discounts. Those crude discounts have gone away. In addition, that decrease in oil field activity has decreased demand for diesel, a product that was growing quickly. So the factors that made PADD 4 the most profitable in the country for a while has made them the least profitable right now, the decrease in oil field activity. And there's also been, as a result of the really good margins that prevailed in the last 2 or 3 years, there have been some projects, not big ones, but because the refining industry there is so small, it doesn't take a lot of incremental capacity. And then when demand reverses, for that to lead to product supply surpluses. And Great Falls, the Calumet's Great Falls plant has just added some additional capacity. Some of the Salt Lake plants have tweaked and increased capacity in those places. And at the same time, the demand has slacked, and their crude discounts have gone away. And so, but it is very different. Salt Lake, it's universally not good in PADD 4, but it's different. Salt Lake is different. Billings is different in Colorado, and those subregions within PADD 4. I hope that answers the question.
Oh, thank you. I've got a question actually for Andy. I was hoping we could return to your comments early in the presentation about in some areas production sort of declining enough that there's not enough oil available to meet minimum volume commitments on certain pipelines. I was wondering if you could talk a little bit about what kind of price distortions that's created, and I mean, what do producers do if they're in a situation where they don't have enough crude, and what are the implications of that?
Well, it's not necessarily the producer who may be on the losing end of this. It's whoever the committed shipper is. And that committed shipper, it certainly could be a producer, it could be a refiner, it could be a trader. So, for a producer, the way to look at it is they just left money on the table if they had signed up for the pipeline space, and they're paying the tariff, and that eats into their net back into the field. For a refiner who's taken committed space, they're in the situation they're now impacting on their refining margin, and as a result, they might have been better off buying on a delivered basis rather than buying FOB, say, Midland or Clearbrook or somewhere else. And the same can be said for what we're seeing on crude by rail. We've had a lot of crude by rail facilities built backed by take-or-pay agreements, not on the loading side, but on the unloading side and the rail lease side. And there are several examples out there that we can see. One is if you were to look at the PBF Logistics SEC filings along with PBF Energy. You can see the minimum volume commitments for the light sweet crude rail rack at Delaware City is about 85,000 barrels a day, and they're actually delivering less than 40,000 barrels a day. On the pipeline side, the prime example that we're seeing is on the BridgeTex pipeline, which is a joint venture between Magellan and Plains. Both of them have come out and said that one of the small committed shippers for 30,000 barrels a day had not been performing, and they were looking for deficiency payments, which they may or may not receive. That company has been identified as Stampede Energy in the news story. So there's a case where you have a small trading company not shipping, and probably the recourse for Plains and Magellan is very limited with a small company. As a result, what you're seeing is the MLPs throughout their earnings season is talking quite a bit about their investment-grade counterparties who may owe them pipeline tariffs on a committed shipper basis.
Thank you. That's helpful. And I guess one for Mark. You spoke a lot about the investments that Delek has made in increasing light processing capacity. Seems like a lot of refiners have brought a lot of light capacity online, sort of just in time for shale producers to start throttling back. Just wondering, sort of broadly, how U.S. refiners are going to sort of be able to transition into a world where there are fewer advantages, and sort of what comes next for refiners in the U.S.
Yeah, thanks. This is an interesting question because obviously, there has been a lot of folks, spend a lot of money on light processing capability. But I think just like a rail crude rack, also, it's basically added to the optionality that all U.S. refiners have for sourcing barrels. So I think what optionality was lacking during the shale revolution was for a lot of us U.S. refiners, both in the mid-continent and then obviously on the East Coast and the West Coast, is to process this new crude that was available for processing. And I think now that, and obviously as most refiners are independent and we don't have, production, we're really, I'm not going to say we're totally indifferent to what crudes we process, but we basically run our LP models and we would like to have the most optionality to select from the biggest variety of crudes available at the prices that they're available at for the products that they're producing. And I think what most refiners now have done and how they're going to move on from just processing this light shale production that was on is that they're going to go back to the way we used to do things, and it's basically optimizing the refinery, taking advantage of all the optionality that you have in sourcing barrels to produce your products.
Thank you. We've got another question from the audience. This question is for Andy, asking if gasoline doesn't pull in the next few weeks, to what extent won't this impact crude runs?
Well, it's in one sense it's possible that it'd be very little, because as long as a margin still remains for the refiners, they'll run full out. But I think the other question is how much would it affect the gas crack and then subsequently the earnings for many of the refiners. And I think that if we were to really pull hardly anything over the next couple of weeks or month, you could see the gas crack decline from about $21.50 today back to $17, and that of course would hurt all the refiners. Consequent with the gas crack going down, we've kind of seen the diesel crack moving on up. So if the combination of the two starts offsetting, the refiners will continue on their merry way and just increase runs and run more than they had last year. But you certainly could see if inventories of both gasoline and diesel remain high, both the diesel and the gas crack get hammered, and runs will, the margins will be impacted and runs will come off.
Yeah, just to add to that, just like I said in my slide, and Mark, I'm sure knows this as well. I mean, refiners are very responsive these days, and they react pretty quickly to market signals. And Mark's company and others have and will react and bring the market back in balance. That's a good thing for the industry because it helps keep it in balance on a longer-term basis.
Well, unless we have more questions from the audience, I think that might be about all the time we've got for today. Thank you again to everyone for participating and for hanging on with us during our technical difficulties. And thank you to our panelists.
Thank you.
Well, thank you.
Thank you, Alison.
Thanks very much.